Moving forward, we now begin with our fourth session focusing changes on TDS, TCS, and crypto. We are excited to welcome Raghav Bajaj, Counsel at Khaitan Co, to share his insights. As counsel in direct tax practice group at Khaitan Co, Mr. Bajaj specializes income tax, corporate taxation, cross-border tax, digital economic tax, cryptocurrencies, transfer pricing, and dispute resolution. A chartered accountant with a strong academic background, he has advised clients in diverse industries and regularly contributes to professional publications and events. Recognized as a finalist in BW Legal World's 40 Under 40 and listed in World's Transfer Pricing Ranking, Mr. Bajaj is also an active member of Rotary International. Welcome, sir. Good afternoon.
Good afternoon. Can you hear me?
Yes, sir.
All right, all right. Thank you for that introduction. And firstly, congratulations for having this kind of a platform and a marathon webinar series. Intrigued by attending the earlier sessions also, especially the not-for-profit or charitable trust taxation section. Now, without any delay, let me go on to my session. Now, the budget has come. Of course, there are the whole increase in the slab rates for non-corporate taxpayers, the announcement about the new income tax bill. Those are the most talked about provisions of the income tax law for at least part of this budget. But if one looks at the ambit of TDS, TCS, and also a very important amendment proposal in relation to the crypto assets, then it becomes a very interesting space to watch out for. So for this is what I'm going to cover the amendment proposal in relation to the virtual digital assets. Now that is the term which has been used for crypto assets or cryptocurrencies in the income tax law. Then with respect to the TDS, TCS provisions, what is going to happen? And also a small update in relation to the startup community. What is the amendment proposal that has been announced with respect to the startup ecosystem? Now, if we talk about virtual digital assets, before 2022, there was no specific regime which was provided in the income tax law when we talk about the gains arising to a person from virtual digital assets, cryptocurrencies, etc. And at that point of time, there were a lot of discussions, debates, because the prices, this is a very high fluctuating asset. So there were a lot of discussions as to what is going to be the nature characterization of the income which a person earns from this asset class. After all those things, in 2022, we had a special regime for taxation of this asset class. Number one, it was defined specifically as virtual digital asset in the income tax law. There were 3 to 4 categories of that particular definition. It was a very widely worded definition. Number two, there was a 30% flat rate tax, 30% plus applicable surcharge and cess, which was imposed on a taxpayer if it earned uh, income from transfer of virtual digital assets. There was a prescribed manner of computing the computing the gains also from that. There was a prescribed manner also for computing the gains arising from this particular asset class. For instance, only the cost of acquisition was to be allowed as a deduction. No set off, etc., was to be there. Then it was also introduced in section 56.210, which states that the receipt of a VDA for nil or inadequate consideration would be taxed as ordinary income in the hands of recipient, just like other classes of section 56.210 tax trigger. And most importantly, there was a 1% TDS, which was introduced in relation to the transaction value when a person would make payment to a resident seller on transfer of VDAs. Now, what has happened is that after that particular amendment, there has been a lot of development and movement when we talk about the crypto assets. Now, globally, there is a lot of talk and discussion as to the transparency and disclosure aspect of this asset class. And it is interesting to note that the OECD is also working towards this crypto asset reporting framework. Now, it is a global tax transparency framework wherein jurisdictions have come together for the development of a framework whereby they can have an automatic exchange of information when we talk about crypto assets. As I understand, it will be, I think 2027 might be the first year when this is when the information exchange starts happening. because ultimately all tax administrators want visibility with respect to whether the transactions are appropriately reported, disclosed, and offered to taxation in the relevant jurisdictions. Interestingly, India is also part of it. India is also actively in developing this, and it is eagerly making steps to ensure a political commitment to implement this CARF. Now, if we talk about what have been the amendments proposed. Number one, the definition of VDA, virtual digital asset, is proposed to be widened, and this is the extract of the proposed new VDA category, that any crypto asset being a digital representation of value that relies on a cryptographically secured distributed ledger or a similar technology to validate and secure transactions. This is a new category in the definition of VDA, which is in the VDA definition, which is proposed to be inserted. What is the outcome? There is a new section 285B which has been introduced, which is proposed to be introduced. And what it does, it inserts a new reporting requirement for this new VDA category. What it will do, it will require reporting entities to report transactions, details, informations, etc., in relation to transactions pertaining to this new VDA category. Uh, the section also envisages that there will be detailed rules which will be introduced, which will be notified by the government in relation to this reporting requirement. For instance, which all persons will be required to comply with this requirement, what will be the scope and of the nature of information, and the manner in which such information will have to be maintained by reporting persons, and most importantly, the due diligence which such reporting persons will be required to carry out for the purpose of identifying who is the crypto asset user, who is the crypto asset owner. So there will be a lot of obligations, a lot of changes in business modalities which the reporting persons will have to comply with. As of now, this proposal has been there. There is a new category of VDA, and there is a new reporting requirement in relation to this proposed new VDA category that has been proposed. Secondly, uh, we all know that there is a concept of block assessments in the context of income tax searches. There is, in that context, there is a term undisclosed income. So virtual digital asset has been included within the definition of undisclosed income also. If we see, this time there have been FAQs also which came along with the finance bill. And if we see, there is a FAQ number 23 which talks about the obligation, this reporting requirement. And if we see, I've reproduced on the screen the relevant question that, why is it being made obligatory to furnish information of crypto asset? So this is the response that they've given in the FAQ. So India is listed in as part of the 52 relevant jurisdictions. Also, if one goes back in history, the G20 leaders' declaration had also called for the swift implementation of the CARF. And to enable this particular framework, this particular implementation, this amendment has been proposed so that the prescribed reporting entities can furnish the details and information in relation to crypto assets. What timelines, what periods will be covered, what kinds of information, details, KYC details, etc. Those are the things which will be notified in time to come. But a very important update which people should be aware of, because this is going to be a reporting requirement, and automatic exchange of information is going to happen once this reporting framework or this reporting requirement comes into being. Just for context, since I said that this video taxation regime had come in 2022, and there were as such no rulings for any period prior to that. But recently, an ITAT ruling had come with respect to a pre-2022 as assets through the 2022 amendment. This was an important one. Of course, there will be a lot of people who would have earned VDA gains prior to the 2022 period. So helpful ruling in at least that context. The second update or the second set of proposals that I'm going to talk about are the TDS TCS provisions. Now, there is a whole bunch of amendments every year that we see every year when we talk about TDS TCS provisions. One thing that we must be mindful of is that it advances the collection of tax which the government gets. Number two, and most importantly, it ensures that there is a tracking mechanism. Because the moment a transaction is subject to a TDS or TCS, it falls within the net of a particular reporting mechanism. And therefore, many times what we will see is that the TDS TCS rates are kept very low. For example, 0.1%, just so that the transaction comes under the reporting net. Of course, there are other scenarios also wherein one will see TDS, TCS rates, I mean, a rate as high as 10%. And there, and of course, wherever there are those high rates, there will be a lot of hue and cry, like we saw in the case of 194R. Now, what has happened in this year? There have been quite a few changes, not just in the context of monetary thresholds, but also to make the ease of doing business very easy. For example, there are provisions in the income tax law which stipulate that every section has got their stipulated TDS TCS rate. Some will say 5%, some will say 1%, some will say 0.1%, whatever it is. And then there are overarching sections which state that if certain violations are there, if certain conditions are breached, then the TDS TCS rate will be applied at a higher rate. Now, what are those situations? Number one, if the PAN is not furnished by the deductee or the collectee. If the PAN is not furnished, then whatever is the rate which is prescribed in the section, we ignore that, and there is a specified formula to compute the applicable rate, which is a higher rate. The reason, so that people are disincentivized from not obtaining PAN or not furnishing PAN. The second category, where the deductee or collectee has not filed its ITR for the preceding financial year. Again, a higher rate will come into picture. And the reason being so that people are incentivized or motivated to file ITRs, because if that is not done, there will be a higher withholding tax rate which is applied. Now, see, these provisions have been inserted in the last few years. And when we talk about the second category of violation, which is the non-filing of ITR, practically, while it is good in concept, what was happening is that for the deductor or collector, it was becoming difficult to implement because no one will know whether the other person with whom one is transacting, whether that person has filed his or her ITR. For example, if I have to receive a payment from Mr. A, Mr. A will not know whether I have filed my income tax return or not. And therefore, it becomes difficult for that person to comply with this provision. As a result, what happens? The payer will end up deducting tax at a higher rate because TDS provisions, as we all know, come with penal consequences for non-compliance. As a result, what happens? A larger quantum, a larger portion or a proportion of capital gets blocked. The working capital cycle gets blocked. And at the same time, it also increases the compliance burden because the payer is now required to ask the recipient as to whether you have filed the ITR also or not. So to ease this compliance burden, to ensure that there is no unnecessary working capital blockage, so that people can use that money in their business efforts, the Finance Bill 2025 has proposed to omit these two sections. That is 206AB, which talks about TDS, and 206CCA, which talks about TCS. And the provision, and once these two sections will be omitted, there will be the higher rate will not apply in case of non-filing of ITR. Mindful that the non-furnishing of PAN category, which leads to higher TDS, TCS, that section will continue. That section has not been tinkered with. So therefore, that particular non-compliance or the breach or penalty, whatever one can call it, that will continue to apply. But as of now, it's a good move that at least the non-filing of ITR by the recipient by the deductee or collectee will not lead to or trigger a higher TDS, a higher TDS or TCS. The second important update in relation to TDS TCS is with respect to section 206C1H. Now here we'll have to be mindful of two sections in the TDS TCS regime. There is a TDS section 194Q, which states that when a person is purchasing goods from a person in excess of INR 50 lakhs, the payer is required to do a TDS at the rate of 0.1%. There is a condition that this will apply if the buyer's business turnover exceeds 10 crore rupees in the preceding FI. As you can see, the rate is very small, very less, but it was done so that the tracking mechanism gets triggered. Along with this, there is a TCS section 206C1H, which stipulates a 0.1% TCS requirement. Again, the thresholds are same, consideration exceeding 50 lakhs, applicable if the seller's business turnover exceeds 10 crore rupees in the preceding financial year. So on same transaction, there were both the things which were applicable. Of course, there is a carve out for TCS provision because the TCS section states that if the buyer is liable to deduct TDS, and if the buyer has actually deducted TDS, then the TCS provision will not apply. So there was a clarity in the law that on any given transaction, both TDS and TCS will not apply. But what was happening is that it is getting difficult for the seller to know whether the buyer has actually deducted TDS or not. Because see, ultimately, again, even though the rate is less, but this was ending up in creating unnecessary compliance issue and administrative hassle for the transacting parties. Because both the parties were asking, okay, whether you have done or I will have to do. If you have not done, then I will do. If you have done, then I will not do. So this led to a difficulty in implementing or doing business. So the government has proposed to omit this particular subsection also, and therefore this TCS provision on sale of goods will not apply. As a result, what is going to happen is that if there is a purchase of goods, only the TDS section will be there. The TCS provision applicability will not be there. Interestingly, many a times this provision comes in, and there are a lot of things on which TDS, at least the TDS part, becomes in negotiation. Of course, many what happens is that the rate is so small, and the amount is so less that many a times people actually end up uh, doing TDS or TCS just because the amounts are very less. For example, shares, people ask whether it is applicable on slump sale, but at least this one part of it will not apply, that at least in the case of a sale of goods, the TCS provision will not apply. This is a very important one and a good one, good amendment from the perspective, amendment proposed with respect to the ease of doing business. The third important amendment in relation to TDS TCS provisions has been that there has been a relaxation which has been provided with respect to prosecution for delayed TCS payment. Now, here we have to be very careful in understanding this particular provision because uh, prosecution for TDS defaults or TCS defaults have been on the rise, at least in the past few years. And many times, what happens is that for companies, corporate taxpayers, the directors at least come at as a as a low hanging risk elements. What the law states is that if there is a delayed payment of TDS or TCS to the government, there is a potential prosecution which can be launched, and it can range from 3 months to 7 years, along with a fine. In the current law, there is no relaxation for minor delays. For example, if I've delayed by 1 day, 2 day, technically that particular provision gets applicable. What will happen if there is a person who has delayed, uh, who has made a delay of, let's say, 20 days, realizes in the next installment that, okay, last month's TDS, TCS was not paid. And by the time the TDS or TCS return comes, they have made the payment because, as we all know, the TDS, TCS returns are quarterly, they have a quarterly time limit. What is going to happen if a person has complied with or regularized this particular default? So there was no particular relaxation for small minor delays in relation to TDS or TCS payments. Now, this last year, a relaxation was brought about when we talk about delayed TDS led prosecutions, which was to say that if the person has actually paid the amount to the government within the timeline prescribed for filing the quarterly TDS return, then the delayed TDS payment will not apply. The delayed TDS payment will not lead to a prosecution. Mind you, I'm saying delayed TDS because I mean that it has been paid. But if it is paid after the quarterly TDS return, this relaxation was not applicable. Now, similar thing has been introduced, or similar relaxation has been made applicable for TCS also. What this will mean is that if there is a delayed TCS payment, the prosecution will not apply, provided the TCS gets paid within the timeline for filing the quarterly statement. For example, if there is a monthly TCS which has to be deposited by, let's say, the seventh day of the next month, if the person deposits it within the 7 days, no problem. If a person deposits it on 15th day of the next month, as per the current law, there was no relaxation. But under the proposal, this particular person will be saved from from any potential prosecution, because this person has paid it before the timeline for filing the quarterly TCS statement. Now, imagine a situation where a person has not paid it within the stipulated timeline of 7 days, not paid within the stipulated timeline of for filing the prescribed quarterly TCS statement, but after that period. So for that particular violation, even though it might qualify as a delayed TCS payment, but in those situations, this particular relaxation from potential prosecution will not be available. Now, this is important because many a times in big corporates and big organizations also, or maybe in smaller ones also, minor TDS TCS payments sometimes can get delayed. Of course, nowadays these all system-driven processes, delayed payments of TDS or TCS are generally not happening because there is enough administrative backing or systems in place to ensure that these things get automatically flagged. But one will have to be mindful that, and there are consequences in the tax auditor report also. So there are enough checks and balances. But one will have to accept that these kinds of delays are possible. Smaller delays, the smaller delays, smaller amounts, etc., can also lead to TDS, TCS prosecutions getting launched. And therefore, it is very important for taxpayers and for taxpayers to know, and for advisors and consultants to make the clients aware that whatever happens, at least there should not be any delayed payment of tax, be it normal advance tax, corporate tax, TDS, or TCS. Because all of those delays come with a preset of potential consequences, penalties, prosecution. There are these kind of relaxations which are there, but one will have to be mindful of the ultimate outcome. Because one more important thing that we should be mindful of is that in case of corporates, when there is a change in directorship, sometimes if at all there is a launch of prosecution, the department launches it with whatever data is available with them, and then a person has to go through the hassle of saying that, look, I am not the director, I am not the person in charge, I was not there, etc., etc. So while all those things are done, but in the first place, if we are able to ensure that there is no delayed TDS or TCS payment to the government within the prescribed timeline, in the prescribed mode and manner, etc., one will be saved from a lot of those administrative difficulties. The next one with respect to TCS amendment proposals is an important one. It talks about when this was introduced a few years back, there was a lot of discussion as to how will it, apply, whether this is in fact a tax whether it is in fact a correct tax to apply in the first place. But be that as it may, it stands on the statute book. And now I'm talking about the TCS, which is applicable on payments under the RBI's liberalized remittance scheme, which LRS as it is popularly called, or the TCS on payments in relation to overseas tour program package. Now, this comes under 206C1G, and two kinds of persons are obligated with this requirement to collect tax. One is an AD bank when it receives an amount for remittance under LRS. And second, the seller of an overseas tour program package. Tour program package, which has been also defined in the law like a combined tour program package. There is a monetary threshold of 7 lakh rupees, which is prescribed in case of LRS. There is no monetary threshold as such, which is prescribed in case of overseas tour program package for the purpose of applicability of this section. TCS ranges widely from under this section from 0.5% to 20%, and we'll go through under which situation it is 0.5%, in which situation it is 20%. Now, what the proposed amendment there is, which has been done by Finance Bill 2025, what is it doing? It is number one, increasing this threshold of 7 lakh rupees to 10 lakh rupees, and how that is going to, uh, impact or affect is something which we'll see in the next slide. And a very important one is that they have now proposed to remove this TCS requirement on remittances for education purposes. But this removal will apply for remittances which are made out of a loan taken from specified financial institutions. There is a section 80E. So this particular exclusion will be linked to section 80E. So two amendments are proposed. Number one, the threshold of 7 lakhs is proposed to be increased to 10 lakh rupees. And number two, TCS on remittances for educational purposes is proposed to be removed, provided that certain specified conditions are satisfied, which is that the remittance is out of a loan taken from a specified financial institution. Very important, these two amendments. Now, if we see how is it going to affect, or what is it going to pan out? See, if we break it down, let's first talk about an overseas tour package. The current provisions, as I said, there is a threshold of 7 lakhs. Now, that 7 lakhs is not a threshold for applicability. That 7 lakhs in case of overseas tour package is in relation to the TCS rate. If it is up to 7 lakh rupees, it is 5%. But the moment it crosses 7 lakh rupees, it becomes 20%. Now, that is a very big limit. I've seen many times, people come and ask us, okay, I am booking a tour program, my cost is, let's say, 9 lakh rupees. It is asking me 20% more. Is it there a law or what? So we have told that yes, this particular provision is applicable. Of course, one will get a credit of it when they file their tax returns. But 20%, of course, is a sizable amount. It can lead to working capital blockage, etc. also, but it is currently applicable. What is being done? This threshold of 7 lakhs is going to be increased to 10 lakh rupees. What will it mean? If a person is buying an overseas tour program package for 9 lakh rupees, 9,50,000 rupees, they will still get the benefit of the lower rate of 5%. The moment now the 20% higher rate will kick in when the tour program package cost is above 10 lakh rupees. So that 3 lakh delta, which was earlier getting taxed at 20%, let's say 3 lakhs into 20% would be 60,000. That 3 lakh rupees, the difference between 10 lakhs and 7 lakhs, will now be taxed at 5% only, which is like 15,000. So to that extent, like in a extreme situation, a 45,000 rupees delta will be saved and ultimately help in a working capital situation. If we talk about LRS, under the current provisions, as I said, up to 7 lakh rupees, there is no TCS, regardless of whatever is the purpose. The moment it exceeds 7 lakh rupees, the rate could be either 0.5%, 5%, or 20%. The 0.5 the 0.5% rate was there if the remittance was done out of a loan obtained from financial institution for education purpose. So a 0.5% TCS if the condition was satisfied. If it was for medical treatment or other education purposes, then the rate was 5%. And for any other purpose, the residual purpose, the limit was 20%. Again, a very high limit, but be that as it may, the rate stands in the statute book. As per the proposed amendment, what is going to happen? Number one, this 7 lakh threshold is going to increase to 10 lakh rupees. Now, as I said, this 10 lakhs in case of LRS is an application threshold, is an applicability monetary threshold, unlike overseas tour program package where 7 lakhs was not the applicability threshold. There it was only with respect to the lower rate and higher rate, but when we talk about LRS, it is in relation to applicability. So under 10 lakhs, whatever purpose, no TCS. But above 10 lakhs, remittance out of loan obtained from financial institution for education purpose, the rate will be nil. So if you see from 0.5%, it has been removed with respect to specified education related remittances. This is a very important one because ultimately India being a young country, people have educational aspirations, etc. So to promote that, this TCS requirement has been done away with. For medical treatment or other education purposes, the rate remains same. The rate remains same at 5%. of course, subject to this threshold of 10 lakh rupees. And for any other purpose, for residual purposes, the rate continues at 20%. Again, the threshold changes from 7 lakhs to 10 lakh rupees. So in TCS on LRS or OTP package, number one, the threshold of 7 lakhs has been increased to 10 lakhs. As a result of which, people are going to save some money. The advancement of tax payment is going to reduce. And second, in case of LRS, the specified education related remittances have been exempted from TCS applicability. Earlier it was 0.5%, now it is nil. So in the OTP, 3 lakh delta, they're going to say 15%. And in relation to LRS, the delta will differentiate because depending on the nature of remittance. But at the same time, if it relates to specified education related remittances, then the delta will be from 0.5% to nil. So that is going to be a saving for people who are making those LRS payments or purchasing overseas tool program package. Then, the TDS rates and the TDS thresholds have been reduced. As I said earlier, there are monetary thresholds which are provided under the law in different sections. For example, 193, which talks about interest on securities, 194, which talks about dividend, 194A, which talks about in the other kinds of interest, 194B, which talks about winnings from lottery, crossword puzzle, horse race winnings, etc. So on the table, these are not very significant or sizable thresholds or rates, but for completeness, I've put them on the screen for as current threshold or proposed threshold. For example, in case of dividend, it is proposed to be increased from 5,000 to 10,000. In 194A is something which I'll talk about. See, currently it is 50,000. The limit is 50,000 for senior citizens and 40,000 for non-senior citizens. Generally, the typical ones which fall within this category would be FD interest, because that is something we just talked about most. Now, this is a very big amendment because the rates for senior citizens have been doubled. So senior citizen will not get TDS hit if the interest is 1 lakh rupees. For non-senior citizens, the rate has been increased by just 25%. So 50,000 will apply to them. At least for senior citizens, this is a big one. And if people are interested in this space, post the budget, there has been an article also that this might lead to increase in term deposits in banks by a substantial amount, because ultimately for a senior citizen, can be TDS can be a bottleneck in terms of what money comes in their bank accounts. But with this increase in limit, there can be an additional inflow of term deposits for banks. Now, one has to read this and understand this in light of Section 80 TTB also. Because see, this limit has been increased for TDS applicability. But when we talk about the final taxation or the exemption, that comes under Section 80 TTB. So there, the limit has not been changed. So what will happen is monthly, quarterly, annually, the senior citizens or the people will get they will get they may get a higher portion of interest, but eventually while filing the tax return or while doing their advanced tax, etc., they will have to be mindful that the deduction limit under that section, which is available for senior citizens, has not been changed. Then with respect to commission, brokerage, fees for professional services, there the limit has been proposed to be increased from 30,000 to 50,000. In case of rent, again, an interesting way. Right now, the TDS is not applicable under 194I if the aggregate payments in a financial year do not exceed 2,40,000. Generally, people understand, okay, 20,000 per month, but it is not per month, it is annual. So even if one makes a one-time payment of 2 lakh rupees, it is not subject to TDS because the limit is not one time or per month or quarterly, it is annual aggregate limit. This limit is proposed to be increased. Now I'll say increase also, or maybe someone can say decrease also, because now the proposed threshold is 50,000 per month. So if one annualizes it, it becomes 6 lakh rupees. But if one looks at it at a monthly basis, if one is making a payment of, let's say, 75,000, and if that is the only payment, then in the current threshold, it is the TDS trigger does not apply. But under the proposed method, the TDS trigger will apply because now the limit is 50,000 per month or part of month. So these are, at least with respect, of course, good that the thresholds are increasing or getting rationalized year on year, day by day, because of, again, multiple reasons: the economy value, the size, the value of money, etc. But in terms of TDS, TCS rates, at least for this year, I think interest one and this rent one is something which is important, which people should be mindful of. And last, the startup related amendment, there is, as we all know, that there is a profit link deduction which is available to eligible startups for 3 consecutive years. So for the out of their first 10 years, they can choose which 3 years they want to opt for this profit link deduction. Again, this has been introduced in law to ensure that startup community ecosystem is motivated, incentivized, or developed so that ultimately there is wealth creation, job creation, economic development. uh, Eligible business there is a concept of eligible business also. Not all startups are can get this benefit. Only a startup which is doing eligible business. As you can see on the screen, I've written eligible business is defined to mean a business which is carried out by by an eligible startup which is engaged in innovation, development, or improvement of products or processes or services, or a scalable business model with a high potential of employment generation or wealth creation. This definition can also be subjective sometimes. In the past, we have seen clients come and ask, okay, will our business model fit into this particular category of eligible business? So there also is scope for analyzing the definition, analyzing this particular definition legally, whether a particular business model qualifies as an eligible business. And once it is there, then the startup can get the profit link deduction provided the conditions are satisfied. Number one, eligible startup is a company or LLP which fulfills these conditions. Its turnover does not exceed 100 crore rupees. Most importantly, it holds a certificate of eligible business from the Interministerial Board of Certification. And the date of incorporation, basically the period within which that particular startup is incorporated, should fall within 1st April 2016, but before 1st April 2025. So that is the incorporation cutoff date which is there in the law. And if anyone who is following up this particular section or space, they will know that this cutoff date is being annually extended because the government is seeing the kind of benefits or the kind of talent or data pool which is getting developed in this space. So this cutoff date was being extended every year, let's say by one year. But this time, in a major boost, what has happened is that the proposal is to increase this incorporation cutoff date by 5 years at one go. Not 1 year, 2 year, 3 years. Now, this time, this extension is proposed by 5 years. So now the cutoff date will become 1st April 2030. What this will mean is that if a startup gets incorporated up to 31st March 2030, next year, the year after that, etc., it will still be eligible for the benefit of this particular profit link tax deduction. Of course, subject to the other conditions to be fulfilled, etc. If Even if it gets incorporated up to 31st March 2030. So this is a big welcome move. And as I said earlier, this, the personal income tax slabs, the proposed amendment to increase this cutoff date, the rate rationalizations in terms of TDS. These are some provisions which I think this time the government has taken a multi-leap forward, and the amendment proposals are not just one year, two year, but taking into account of considering the needs, aspirations, etc., for the next 4 5 years of our economy and country. So this was a brief summary in relation to the TDS, TCS, and the virtual digital asset related proposals of this year's budget.
Thank you, sir. Thank you so much for this insightful session. I think the audience must have benefited from it. There are a couple of questions. Should I take it?
Sure, sure.
Just 1 second. Uh, the first one is whether crypto derivatives such as crypto ETF would fall within the definition of virtual digital assets.
Crypto, I think this question is going on lately post this amendment, crypto futures, crypto derivatives. Uh, it will have to be seen in detail. Let me not give an answer here as of, but it will have to be seen in detail. The definition is very wide. But the crypto asset reporting framework is also something which we should be taking a look at, because there the definition and the meaning of excluded assets or the included, like they have a concept of closed loop crypto assets also. So it will have to be seen. It is not clear as of now.
Okay, correct. The second is one user has asked whether Section 194F would be applicable on waiver of loan which is obtained for purchase of capital asset.
Before?
For purchase of capital asset.
No, can you repeat 190, which section?
194R.
So there was a circular also which was there. So I think they should definitely refer to that particular circular. It was dealt with in that. And as I said, 194R has created a lot of trouble. I mean, trouble in the sense people are now required to ask a lot of details with respect to that TDS trigger.
Thank you, sir. Thank you so much. That's all from our side.
Thank you. Thank you. All the best.
Thank you, sir.